Good morning, people. Welcome to Business Mastery Live Wednesday. We're going to get started in about a minute. All right. Good morning and welcome again to really 10-figure Business Mastery Live Wednesdays. Excited to be here with you today. Today is April 26th. Wow. We're moving past this year really quickly. It's just amazing to me how much time flies. 2023, we're coming to the halfway mark inside of this year. How are you doing with your business this year? I know we are actually doing a better improvement from last year. This is always what we want. We want to see the growth year over year inside of business. You want to experience that too. We always want to progress inside of what we're doing in our businesses. We want to see that actively. So many people that we work with that are experiencing the same thing. There's a lot of growth inside of what they're doing. And along with that comes an evolution of who you are to be able to handle the next level, the next phase of business, which is why we have these webinars so that you're able to see yourself as that new being who can handle that next level of business and next level of life. So that's why I'm excited today to come to you with these webinars. One of my favorite times of the week, really. I like doing these with you guys. I like talking about these topics inside of business, just to have mastery inside of it. They're just as beneficial for me as they are for you if you're watching. They're a reinforcement, as you will, to what I already know inside of a business. There's a new level of accountability. It wants to be in place for where we are over here and inside of what we do, which is always exciting. I can get to see that new version, that new iteration of me that has a new level of accountability, integrity, and mastery in business. So thank you for who you are, for being here and giving me the opportunity to share this information with you. And with that being said, let's get started. All right, so business mastery. This is me, just in case you did not know. I am Cheston Bulgin with By the Books Consulting. This is how you reach me. 888-4BTB now, that's the main line. You can reach us at bythebooksconsultants.com, and this is my email address. Now, we specialize in the numbers and the business systems and structures and making sure you get to keep more of your money. So if you ever feel as though you want to reach out to get some clarity in these areas, do so. This is how you do it. And a quick disclaimer before we get started. The following is for educational purposes only, is not to be considered financial accounting or legal advice. Please consult your tax, accounting, and or legal professional for specific advice. And of course, we want to forward the conversation always. In order to do that, your feedback is wanted. I want to bring relevant topics to you each and every week. Also want to make sure we're bringing on the guests and the speakers who can deliver those things to you when we start adding those people to the calendar. For the most part, you've been hearing me share a lot of insights on business system structures, the financial literacy, the mindsets. At the same time, we want to have other people bring to you some of the things that will help you catapult your business to the next level. So if you want to forward the conversation, I know you do, reach out, let me know. What do you want to bring to our conversation so that we can help you get to those next levels? And you can do so by reaching out to me on Instagram, LinkedIn, or send me an email, or even drop a comment in one of the chats for these live webinars. All right, so 10-figure business mastery. This is what we're up to here inside this mastermind group. If you didn't know, now you know. We stand on 4 pillars. One is intentionality, which we also call mindset mastery. It's the way we process life. And number 2 is financial mastery. We call this financial literacy, or understanding the number story, being able to read that and make decisions based off of that. 3, we have structures, which we also call system mastery. And last but not least, we have actions, which is also known as execution mastery. Each one of these by themselves is critical and of utmost importance for us to be aware of and utilize inside of what we are up to in our businesses if we want to take our business to the next levels of life. Intentionality is where it starts. Of course, we have to have the proper mindset. We have to understand, like, where is our focus and attention. This is where a lot of people get taken out in life. I'm realizing this more and more with the more people we work with. We get stopped. People, human beings, we get stopped if we don't have the right focus. If we're placing our attention on things other than where we actually want to create in life. What do I mean? There's so many things that go on in this world. The news, there's so much suffering. There's so much that we need to take on in life today just to live and move about. It can be like that. We can have our focus and attention on these things that really are areas of life in which we say these are things that we don't want. These are things that we don't want to experience. These are things that are hardships. These are the negative things, quote unquote, negative things that happen in life that we can 100%, you can place our attention on those things. Those things are very real. Life happens. Life gets hard. You know, you're raising your kids. You're in a relationship with your significant other, and you want to make sure that everything works out. Sometimes I had a friend of mine, a mentor of mine, really talk about how with the Stripe, they put a freeze on his account because one of his clients, one of his customers, decided to do multiple chargebacks. It was just one. They do thousands of transactions, but one person did multiple chargebacks, and as a consequence of that, his merchant account is frozen, something that he is leveraged highly on. You know, they do hundreds of thousands of dollars in expenses every month. And now the revenue to support those is on hold. The thing is, well, who we're going to be about that in those situations, the tension could go into, man, this sucks. This is like a hardship that I'm facing. And I don't see my way beyond it. And it could really send us in a downward spiral. The difference is, for you and I, as leaders and entrepreneurs, people who are looking to achieve freedom, wealth, and legacy inside of what we do, we don't have the luxury of letting ourselves place our attention and focus on those things for longer than a moment. We need to have the integrity to get back to what it is that we're creating so that we can understand what the next action is going to be. That is the importance of intentionality. The things that you and I see out here in reality, the life that we live, are nothing more than lagging indicators of what we have believed up until now and what we have placed our attention on up until now. Get that. This is a conversation. And I don't know if you're on this and listening to this, if you really got what I just said, but if you understand that what we experience right now in our reality is nothing more than a lagging indicator of what we believe and what we have placed our attention toward up until now, then we will have a shot at changing the game completely. Because now we can place our focus and attention on the things that will actually give us new lagging indicators based on what we believe from now on, what we place our attention toward from now on. And I'm hoping that makes sense. But that's intentionality. Financial mastery, of course, we talked about that. We want to understand clearly what the numbers say. Right? You want to have this skill set. If you don't have the skill set, you want to have somebody on your team that does. And of course, structures. We've been talking about structures all year long so far, and this is going to be no different. We're going to actually elevate the conversation inside of structures today. Right? When they're talking, we're also going to talk about what potential actions there may be. Okay, so now we're driving things forward in 2023. We're still talking about structures, and today we're going to talk about business structure, and the main focus is going to be on S corps today. Right. So let's get into this conversation. So, just a little bit of background. You see here we have something we call sole proprietors, partnerships, and disregarded LLCs. So I'm going to talk about this a little bit to give you background. I get a lot of communications and feedback from people that lead me to believe that there is not a real good understanding of these structures and what they mean and how to use them inside of business, which breeds what we call confusion. And when we have confusion, we don't execute properly. There's a hesitation and there's possible mistakes inside of actions when we don't have clarity. And instead, with clarity, we have confusion. So I want to clear this up. Like sole proprietorships, call it sole props, right? So you're actually running a business on your own. You're the only owner of this business. And you don't necessarily have to have any structure other than yourself. You say you're going to go out here, you're going to get some insurance, you're going to do a service or sell a product. And it's just you by yourself. Okay. Now, by the way, we're going to be doing a boot camp for QuickBooks. We did one in March. We're going to be doing another one in May, on May 7th. This one is going to be specifically geared toward contractors. Okay. I will be posting the access for that. All right, we're creating something brand new inside of membership so that we don't have to charge people so much for webinars. When they come up, you can get a membership for a reasonable amount. You get access to all webinars each and every month for that fee. And though for those of you who don't have bookkeeping services with us, we can include that inside of a membership upgrade for you too. So you get access to our bookkeeping services, and actually one-on-one. You can get one-on-one coaching every month inside of what you're doing in your business, as well as get access to all of these webinars, this group, and the boot camps that we do, and anything that we share as far as resources and tools to help you level up inside of your business. All right, so that's going to be made available. This is going to be brand new. The idea and the intention is to help you do this thing that we talk about here inside of our Business Mastery Live Wednesday groups and webinars. Okay, so we'll continue to look for that. We'll be providing that over the next day or so, giving you access to the next boot camp coming up and the memberships. All right, definitely excited about that. Excited to be with you in that way. I really do want to be at a level to give to you fully whatever I can from my own understanding, expertise, and experience, so that you can move whatever you have in the way out of the way and just go hard at your business and have the life you want through it. All right. So that's a side note. That's coming up. Okay. So be ready. If you have QuickBooks, if you ever think about using QuickBooks, we're doing that boot camp on May 7th. That's a Sunday afternoon at 2 p.m. It's going to be 2.5 hours and maybe a little bit more. All right. So it's scheduled for 2.5 hours. A lot of value, a lot of insight. All right. So sole proprietors, single person doing business. Partnerships are similar to sole proprietors because there really doesn't need to be any structure around that. other than two sole proprietors getting together, say we're going to use our skill sets and talents together to do business. Okay. Now, the main thing around these specific types of business structures, there's no distinguishing you from your business in terms of income, in terms of protection and everything. There's unlimited liability when you're out here running your business as a sole proprietor and or a partnership without any structure around it. Okay, that is one of the main things. Actually, two of the main things. Income is directly yours. There's no distinguishing your income from the business income, which can make it a little bit challenging to really level up inside of what you're doing because it gets commingled, which is never a thing you want to do. When I say commingled, you're not really separating the business financial activity from your personal financial activity. You always want to do that, right? But the tendency to, when it's all yours is to mix it all together. This is what you find when people start out in business. They use their personal accounts to help manage their cash flow, and that's not a really good practice from the start. You really want to have foundational practices that work from the beginning, which is to separate those. Especially when you're doing a partnership, because now there's an accountability to somebody else. You want to have a single account that you use for your business in the partnership. Okay. Now we're going to talk about LLCs, which are we call disregarded entities. When we talk about disregarded, it means that it's disregarded in terms of how the income flows for your taxes. For the IRS and the State Revenue Department, they don't look at the LLC for any type of income tax treatment. They do, however, if you're a partnership, want to see the business reported revenue so that they can understand, well, which partner gets which income or how much income from this operation. But it does not, however, distinguish that income individually from the partners. It belongs to those individuals. Okay. That's what we mean by disregarded. There's no income tax treatment on this type of entity. So when you choose an LLC, for example, you start your business and you already had an LLC out here and you created it for, you want to have protection. You want to make sure you were doing things the right way. However, when you form that LLC and you're an individual, you don't have any other members beside yourself, you are treated as a sole proprietorship for income purposes, income tax purposes, which means that income belongs to you as an individual. You report it on your individual tax return on the Schedule C. Okay? No distinguishing that income from you, other than you filing that Schedule C on your individual tax return. Now, the main issue with that, which is going to be the same issue with just having a partnership, is what we call self-employment tax. Well, how do you handle that? A lot of people get blindsided come tax time because there's a huge bill for regular income tax and self-employment tax, something that is usually handled when you get a paycheck. So if you've been working for a company and you've been getting the paycheck, normally you'll see that Social Security, Medicare tax taken out of your paycheck along with federal withholding. So you'll see those line items on your paycheck. Now, and when you have a paycheck, you're only seeing half of that amount taken out. Your employer has the other half of that expense. So if you look at it, when you're in business for yourself, you have two sides of the coin. Whereas if you were not working for yourself, you're working for somebody else, you just have one side of that. The two sides that you would have working for yourself are the employee side, because you're actually an employee of your business, and then you have the employer side, because you are an employer of your business. Now, I'm saying this because as a sole proprietor, you have unlimited exposure to this self-employment tax. It's all earned income. It's all your profits from your business is considered to be self-employment, and therefore requires you to pay self-employment tax. Both sides of that, it's 15.3%. Okay. Now, if you had just in the employee side of it, if you were working for somebody, you'd only see in page 7.625%. But since you are the employer and the employee, you have 15.3% of an additional tax liability for whatever profits you make on your business. This is very important to understand as we lay the foundation for what we're talking about today, because we're going to talk about S Corps and why people choose S Corps is to really have control over that self-employment tax portion of your tax liability, which is fantastic. Okay. Now, a lot of people that I see, they really don't understand. They don't really move into something like, choosing an entity election. They don't really do anything other than just form the LLC and then go about doing the business. And then all of a sudden, now they have this extra tax burden that they didn't realize when they start making good profits on the business. All right. Now, you see on this slide here, we're talking about, protection that LLC provides. Fantastic. If you don't have an LLC, you're just running as a sole proprietorship or partnership, you don't have any protection at all. Okay. And the other side of this is what we're talking about, tax treatment and how it's recognized by the IRS. There is no tax treatment and recognition for LLCs by the IRS. There's a default underlying treatment that you would receive based on who's running the business. If you're an individual, you're going to be treated as a sole proprietor. If you're more than one, if you're a multi-member LLC, you're going to be treated as a partnership. And hopefully that makes sense. If you have any questions about it, just let me know later on in this chat, and we'll be happy to answer any questions about that. All right, so now we're going to talk a little bit more so about flow-through or pass-through entities. Okay, so an LLC is what we call a flow-through entity, which means that, the company, if you're a multi-member LLC, it means you did just like how we talked about just now. If you have more than one member of that LLC, they want you to file what's called a 1065, a partnership return, to report what the income was for that business so that they can see what the distributive share of income is per member of that LLC or per partner on that LLC. What does that mean in layman's terms? Okay. Yeah, so you do have to file a return for an LLC if there's more than one of you inside of it. That form is called a 1065. It's an additional tax return for that company. But the thing is that that company does not owe any taxes. It's just there to report how much income came to the entity, to the partnership, so that the IRS and the state revenue department can see how much to tax the partners on the individual side. So this is what we call a K1, that kind of conduit from that partnership to the individual. So each 1065 return, a partnership return, will have how much percentage ownership does each member have on it, and they'll be issued a K1. All right, that K1 shows that. It shows the percentage of income that was reported to that partner based on the net profits of the partnership. And then those partners will take that K1 and put it on their individual tax return, and then that's what's going to be taxed at the individual level. That's when income tax comes into play. Income tax does not come into play at the partnership level, like when we file the partnership return. It only comes into play after that K1 is given to the partners and they put it on their individual return, and then those individual partners pay taxes based on how that K1 impacted their individual finances for that year. Okay, so this is a pass-through concept, right? There is no income tax or income tax liability rather for these entities themselves. They don't pay tax. The owners individually pay tax at the individual level. So when we say flow through, it means that income from the company flows through to the owners to be handled on the individual level. Now, I'm saying it like this, and I want to make sure it's clear, because a lot of times we get confused about what that looks like. And people ask me all the time, well, am I going to be paying taxes on this return? How much tax do I have to pay on my partnership return? So when they say that, I know they really don't get it. There is none, right? The only thing that you really have to consider about when you're looking at these different entities, like if you have a partnership set up, is the franchise tax for the entity that you created. Creating an LLC in the state of North Carolina, then you got to pay your $200 franchise tax a year, or that 1%, depending on how much revenue you're bringing in. Okay, but there is no income tax for that entity. Now, we're talking about the focus of our call today is going to be S corporations, which is another pass-through entity. Same thing. S corps don't pay taxes. The shareholders pay taxes, depending on how much income that S corp generated. Now, the main thing about it, we talked about a little bit earlier, and this is also what we talked about. We talked about the 1065 form, just to give you some emphasis here. This is what a partnership return looks like. And then we actually take this K1 from the partnership return, which is the percentage share of the income per partner, and give that to each individual partner or member so that they can file that on their individual return. Okay. But we're going to talk about S corps now. And one of these days, we're going to have a real good long talk about each one of these entities all together. Today's going to be a little bit of a shorter talk about S corps. This is another pass-through entity. A lot of popularity that the S corps have when people are talking about structures and tax savings, and you want to understand why. First of all, S corp is a corporation that elects to have passed through corporate income. That should be passed through a corporate income, or losses and deductions and everything else that go to the shareholders. Pass through entity, man, just like your partnerships. Okay, so if you're a shareholder of an S corp, the great thing about it is that you get that's different than partnerships and sole proprietorships, is that you get what we call passive income from your S corp. A good portion of your profits is considered passive income to the shareholders. Why is that important though? Because self-employment tax is on earned income. You don't pay self-employment tax on passive income. What is passive income? Well, it's income like, rental, real estate. You have a real estate portfolio and they pay rents, and that's passive income. You're not working, you're not going to a job. It's just money that comes in regardless of whether or not you go to a job. Don't get me wrong, you can be active in it, but it's not considered earned income. Earned income is when, you go to work and get a paycheck. You provide a service. You sell products. And you have to put your time and labor into it, and you earn money. The thing about, passive income is that, you invest in something and that returns something to you regardless of you going to work. This is the income source that you want. This is the income source that presents a lot of security in life. S corps provide you this type of income, but it's a hybrid approach because some of that income is considered earned income. Now, in order to make sure you're getting the most benefit out of your S corp, you want to understand that you want to limit the amount of earned income you have and maximize the amount of passive income you have, so you're not subjected to the self-employment tax for those earned income earners. Now, what does that really look like? All right, there's a requirement, there's a compliance requirement inside of S corp, so we're going to get to that really shortly. But first, I want to understand some compliance things about S corps. The shareholder of an S corp cannot be an LLC, partnership, or other corporation. It needs to be an individual, and it can be a trust. Okay, real clear to understand. All right, and the trust is another thing we want to talk about at some point soon to understand how your setup wants to be. And then you have to have less than 100 shareholders in an S corp. No more than 100 shareholders is what I want to say. These are the two things you really want to understand about it. The compliance things and the compliance around an S corp also indicate that you want to have your meetings, annual reports. You also want to have your reasonable wage that you pay to the shareholder in order for this to be compliant. Here's the benefits of your S corp. There's no corporate tax on it. It's a pass-through entity again, so it doesn't pay tax on a corporate level. And it reduces the self-employment tax to the wage portion of your income. So if you're an owner of an S corp, you pay yourself a wage, which is the compliance that we're talking about. You want to pay yourself a reasonable wage, reasonable salary. That is subject to self-employment tax, and that alone. The other income, let's say that your company made $100,000 net profit. Well, you can pay your wage as $40,000, and $40,000 of the wage that you pay yourself is subjected to the self-employment tax, which is at 15.3%, is somewhere around $6,000. Right, it's around it's a little over $6,000. Whereas you would be paying, if you were not an S corp, you would be paying self-employment tax on the entire $100,000 profit, which would make your tax roughly around $15,300. So just by making that switch and paying yourself a wage, you've saved just about $9,000 in taxes. Ooh, just by doing that, just by filing some paperwork and complying to things, you saved about $9,000 based on $100,000 of net income. Man, wow, super fantastic, right? But a lot of people don't understand this. This is why we end up paying more so than what we need to inside of this, right? And then there are also other credits available for S corps that are not available for other entities. So you want to take a look at considering how you're using your S corp if you have one, or if you don't have an S corp, how to shift into one if you're making a good amount of money inside of your business. Now, I will say this: the benefit of an S corp is only to those who are actually making a significant amount of profit in their business. So if you're not really profiting more than $30,000, then it might not make sense for you to have an S corp, because you're not going to have that much in tax savings, and it causes other compliance things to go along with that. You're filing a business return that costs money, and the annual reports, annual meetings, all these things that you have to do for compliance, the payroll, and all those administrative costs that are associated with that. You want to have a complete understanding of the cost benefit before selecting it. But if you're making more than $30,000 in a lot of states, this is when you want to start considering S corp status. Okay, and also you want to also consider that there's a limit, right, to Social Security tax, which is the lion's share of your self-employment tax, is Social Security. Well, Social Security wages cap out at $160,000 for 2023, $160,200. So if you're making significant amount of money with your S corp and you're paying yourself a wage of $160,000, you're really not saving any more than that $160,000. Only if you're paying yourself maybe less than $100,000 are you saving more so on that Social Security tax portion of it, which is the lion's share, is 12.4% of that 15.3. Okay. Now, the other thing is asset protection. Just like LLC provides, separation from the owners from the business. So you're protecting your personal assets, whatever the assets are inside of the company, or what your assets are, what your liability is limited to. And then, all these other things, tax strategies like retirement and health insurance, your tax deductible. Right. And then, man, the other benefit to the structure is being able to capitalize your business through shareholder equity. You can take on more shareholders and have more capital in your business, and that's how you can finance your operation. So a lot of things to think about when you're doing an S corp. Some of the downsides of an S corp, we talked about a few of those things. Compliance, you really want to understand the compliance of it and do things by the book. If you file late for the S corp, it sucks. You don't want to file late. You want to file these on time. S corp returns are due on March 15th. They're due a month before the individual returns. Partnership returns, by the way, are due a month before the individual returns on the same day, March 15th. You can file an extension as long as you do it before the March 15th deadline. You can file an extension, and you can do it in September, 6-month extension. So it'll be due September 15th. And you'll still be compliant. Now, if you file it late for whatever reason, it's a $200 per month charge per shareholder that you're late. I've experienced people who just didn't want to file their taxes. You freaking entrepreneurs. Don't want to file taxes, man. And especially S corps, if you don't file them year after year, You're talking about several months at $200 per shareholder. You can do 24, 36 months at $200 per shareholder, right? That you're paying in fees and fines, penalties. All right. So you want to understand, if you're going to do this, the idea behind this group and what we do here is to make sure you level up in business, and it requires something. It requires a level of integrity that wants to be in place, so that you can level up inside of your business, and you just want to make sure you do those things without question, so that you can get the result that you intend to get out of them. Okay. So this is one of the main benefits of being inside of a conversation like this, is because you don't have to go in blind when you're doing these things. You can understand what you're dealing with, and you can make a choice. Okay. The other thing that you want to consider, it is an extra return that you file, and there's an extra cost. It can be it's like somewhere between $1,000 and $2,000 to file this return, depending on who you go to get it done. All right. Right now, we do these. We start ours at right around $900 for doing S corp returns. Okay. So it can be less, and you want to understand the implications of it when you're doing it too. So that's why you want to really look at a professional to prepare these things, because if you don't do it the right way, it can raise red flags. And you could do it on your own if you're willing to go there and do the work and understand how to file it and make sure it's it's looking the way it needs to look. Especially if you're in financial mastery, you understand the number story, you understand how to report these things, then by all means, take it on. Make sense? But super fantastic. We're gonna start bringing this in with this last slide here. How are you going to use this? All right, we had a lot of talk around S corps today. We did talk about other entities and everything else, but how do you want to strategically use an S corp inside your business based on what we discussed? It's a great combination of asset protection and tax reduction. All right, you definitely want to make sure you're compliant and pay yourself a wage. A sweet spot, you really, if you're in your S corp, is to pay yourself 40% of net profits, or you're going to pay yourself the industry standard wage for your position, whichever is the greater of the two. Does that make sense? I don't know if I want to say it like that, because sometimes, if your profit doesn't justify you paying yourself the industry standard wage, then that 40% mark is what you want to stick to. That's how that wants to be said. Now, if you're making significant profit in your business, then you want to look at the standard wage for somebody that holds the position in that industry and pay yourself that. And the other benefit, the thing you want to do is make sure you take your distributive income for yourself. Whatever the profits are of that business, they belong to you, whether it stays in the assets of the company or not. When I say that, like if there's an amount of profit that the company has after you pay yourself your reasonable salary. Now, if you keep that, like let's say you retain the earnings inside of the business and you don't take it as distribution to yourself, like you don't pay yourself another check from your business, which is a distribution, right? I take money from the business and put it and pay myself personally directly outside of wages. That is a distribution. Okay. If you do not do that and you decide to keep it inside of the business, for taxes, it does not matter. That's still considered your distributive income for the business. So you want to understand that and use that strategically on how you're going to manage your own individual life outside of the business. All right. So that comes into the next thing, which is really know your profitability each quarter so that you can make these adjustments and really know what you're going to do. You're going to have to pivot every now and again because your business will have flux. It's not going to be the same thing always. You can plan, you can execute, but there's always going to be a little bit of flux between what the reality is and what the intention is. So you want to keep a close eye on these things. All right, guys, this was a fantastic conversation to be inside of. Definitely great being with you today to talk about these things. I'm hoping this added some value to how you've been conducting your life and conducting your business. And I will see you next week on the next live webinar. All right, guys, take care. Have a great week, and I'll talk to you later.